As of the most recent market close on Friday, June 5th, 2026, at 4 p.m. Eastern Standard Time, Plug Power stock sits at a price of 3.22 per share, marking a significant drop of 10.69% during the final session of the week. This intraday sell-off pushed the stock down 39 cents from its opening price of 3.50 on an absolute surge of trading volume that reached nearly 80 million shares. When a stock faces that level of selling pressure on such heavy volume, it tells you that major institutions and individual retail traders are repositioning themselves rapidly, completely altering the immediate technical setup of the equity. While the broader clean energy community keeps focusing on the headline-grabbing policy debates or the latest factory ribbon-cutting ceremonies, the real story for this stock right now is a rapid, fundamental reshaping of its balance sheet liquidity that mainstream analysts are completely misinterpreting as a simple cash burn problem. Most people see a double-digit drop in a single day and assume a company is on the brink of structural failure, but what they miss is that Plug Power just closed a massive $39 million federal investment tax credit transfer for its St. Gabriel hydrogen liquefaction plant in Louisiana. This move follows a similar $30 million credit transfer from their Georgia plant, meaning the company is effectively bypassing traditional expensive corporate debt markets to fund its operations through infrastructure monetization. The common view of Plug Power is that it is a highly volatile speculative vehicle that burns through cash too fast to ever achieve stability, causing retail investors to treat it like a lottery ticket rather than a core industrial holding. The general market narrative says that unless green hydrogen receives immediate massive government subsidies across the board, companies in this space cannot survive without continuously diluting their stockholders. This view forces people to look at traditional clean energy investments through a narrow lens, expecting constant emergency equity raises or crippling high-interest loans to keep the lights on. The reality, however, is far more complex and interesting because Plug Power is systematically shifting from being a pure manufacturing play into a vertically integrated infrastructure logistics provider. While retail traders are busy watching the wild daily price swings on the Robinhood app or debating entries on various online investing sites, the company is quietly building out a real-world physical clean energy network capable of producing 40 tons of liquid hydrogen per day across its active domestic footprint. This means the expectation of a sudden corporate collapse ignores the massive, highly tangible industrial infrastructure that now supports the underlying asset value, creating a massive disconnect between how the stock is priced on an individual brokerage platform and its actual replacement cost in the industrial sector. Looking closely at the recent stock movement, the weekly chart shows a sharp reversal from the brief rally that carried the stock up towards the $4 mark earlier in June. That selling pressure intensified throughout Thursday and Friday, driven by an options market that saw a heavy shift towards protective puts and a rapid unwinding of short-term call options. This institutional activity signals that while the company is successfully making operational progress, big money managers are still demanding a much higher risk premium due to macroeconomic pressures, including persistent high interest rates that make capital-intensive projects difficult to model long-term. The volume spike we saw at the end of the week suggests a capitulation from short-term momentum traders who were betting on an unbroken extension of the May rally. Instead, the stock broke through its short-term moving averages, forcing automated trading systems to trigger sell orders that accelerated the intraday slide down to the 3.25 range. This type of sector momentum is highly correlated with how clean energy behaves as a whole, but Plug Power is experiencing amplified volatility because its high short interest regularly creates massive friction between short sellers trying to press the stock lower and retail buyers attempting to build a long-term bottom. If you look at the wider landscape of online investment, institutional investors are playing a much different game than retail participants, using complex derivatives and structured blocks to hedge their exposure rather than buying or selling flat equity shares. This creates an environment where trading platforms like Interactive Brokers or the Fidelity trading platform see massive block trades that distort regular retail order flow, leading to rapid, unprompted drops that can easily scare an individual investor who is managing a self-investing account. Understanding these mechanics is vital because the daily volatility is often a reflection of institutional hedging rather than a sudden shift in the company's core operational health or its factory output. let us pause for a moment to look at how this company actually operates underneath the ticker symbol. Plug Power designs, builds and operates a comprehensive hydrogen ecosystem that covers everything from production and storage to final delivery and power generation. Their primary commercial success has historically been built on their GenDrive fuel cell systems, with tens of thousands of units running material handling equipment worldwide, powering forklifts in massive warehouses for some of the biggest logistics companies on the planet. They have built an integrated network that tries to solve the classic chicken and egg problem of clean energy by providing both the machinery that uses the fuel and the actual fuel generation plants needed to keep those machines running. Comment below how many shares of Plug Power you currently hold in your portfolio and whether you are buying this recent dip or waiting for more clarity. Historically, the business model relied heavily on importing or buying hydrogen from third parties, which created a massive variable cost problem whenever supply chains tightened, causing gross margins to look deeply negative in older financial reports. To fix this, management pivotally shifted towards domestic production, building their own massive green hydrogen plants in Georgia, Tennessee and Louisiana to control the entire supply chain from water electrolyzers to liquid delivery trucks. This transition from an equipment reseller to an industrial utility provider is a multi-year process that requires billions of dollars in upfront capital, which explains why past performance metrics show heavy losses and consistent cash consumption, despite strong, steady revenue growth. Recent quarterly reports show that this infrastructure bet is beginning to show some early structural results, with revenue growing over 20% year over year and gross margins showing significant technical improvement as internal production begins to displace expensive external fuel sourcing. The operational scale now includes over 74,000 fuel cells deployed globally, alongside massive megawatt-scale electrolyzer installations at major European oil refineries and international industrial ports. This extensive physical footprint means the business is deeply embedded in the supply chains of corporate giants, making it very different from a software startup or a speculative technology concept that exists only on paper. When we shift our gaze towards the future outlook, the ultimate trajectory of this stock will depend entirely on how management bridges the gap between their massive infrastructure spending and true cash flow positivity. The key catalyst to watch in the coming weeks is the annual shareholder meeting, where the leadership team will face intense scrutiny regarding capital allocation and their strategy for optimizing their existing assets without tapping the public equity markets for dilutive raises. If the company can prove that their infrastructure optimization initiative can generate steady, reliable liquidity through tax credit transfers and strategic joint ventures, the market will be forced to re-rate the business based on its industrial utility value rather than its historical cash burn rate. The opportunities here are substantial, particularly as heavy industries like steel manufacturing, chemical production and maritime shipping face massive regulatory pressure to decarbonize their heavy operations. Plug Power's massive electrolyzer systems are uniquely positioned to serve these industrial markets, offering a clear path towards large-scale commercial contracts that could dwarf their traditional warehouse forklift business. If reality turns out to be an accelerating industrial adoption curve driven by these large corporate mandates, the current conservative market narrative will look incredibly short-sighted to those analyzing the stock on standard investing sites. Conversely, the risks remain exceptionally high, especially if macroeconomic pressures keep the cost of capital elevated or if unexpected operational delays slow down the ramp-up of their newest production facilities. A clean energy company that relies on continuous capital efficiency cannot afford prolonged technical friction at its main manufacturing hubs without triggering another round of liquidity concerns that would quickly embolden short sellers. If the company fails to maintain its current pace of liquidity improvements, the stock could easily test the lower bounds of its historical range, punishing aggressive buyers who ignored the structural realities of capital-intensive engineering. Ultimately, the persistent battle between market expectation and industrial reality is what makes this equity one of the most compelling stories in the modern market. The crowd expects a predictable macro story driven entirely by interest rate updates or clean energy political debates, missing the micro-level structural improvements happening within the company's internal logistics and tax asset monetization strategies. For an individual managing an individual brokerage account or utilizing tools like Schwab Intelligent Portfolios, navigating a position like this requires looking past the daily emotional noise of the trading screen to focus on physical production capacity and real-world asset value. By evaluating the company through its operational infrastructure rather than its short-term trading volume, you gain a massive structural advantage over a market that remains hyper-focused on the next 24 hours of price action.